at Rehmann, Doug Barber. Hi, Doug.
Good afternoon, Bart. Good
to see you. Welcome back in person.
Exactly. It's nice to be out. As I said, I actually broke out a tie for today. It seems the one downside or upside, from our perspective, the last 2 years has been the fact that everybody kind of got a lot more casual. So certainly sport coats have been more the norm than suits and ties, but felt good to be out.
You know, I was talking to my dry cleaner, who's a neighbor of yours on Robinson Road, Legacy. He said business, because of that, just for that reason, it's been down 30% industry-wide.
Sure.
Yep.
Well, if they're like me, I would imagine I was always a bad guy. If I have a salad and I try to eat it with a tie on, that tie ends up at the dry cleaner. So it's saved a little bit there, and definitely the suits.
Yes, I too use ties as napkins, not on purpose.
Yeah.
Well, the pandemic's really causing so many issues, and now the war in Ukraine adding even more to that. So much uncertainty,
Right.
you know, financially. One thing though we are seeing is prices going up and inflation, which is now being reported and measured, which, you know, for many years nobody even, I mean, it didn't exist really, did it?
Right. Inflation, if you look at the headline numbers for last month, was 8.5%. That's as high as it's been since 1980 when it was 11%. So it's been significant. If you strip out, they got what they call headline and core. Core removes food and energy, which are two of your more volatile components. It's still up 6.5%. And we just haven't seen this in years. And it's something of a natural offshoot. The government response to the pandemic was to print a lot of money to stimulate the economy and spend a lot of money. And when you add that to supply chain issues, it started the inflation last year, and then certainly it boomed with the war. I mean, Russia is, the third largest oil producer in the world, and between Ukraine and Russia, they account for somewhere between 25 and 35% of the wheat.
Wow. So when costs increase because of supply and demand, is that part of inflation?
It is. Many times that part of the inflation is really considered producer price inflation. So the raw materials and inputs, I mean, it feeds right through. You know, as you talk about Tom Rooney, I mean, you could go talk to Tom about the cost of food. What happens? His inputs go up, therefore and his labor costs go up, and he has to pass those on to everybody else. So it just works its way right through the chain from the original materials to the end product. One
of the things I think people are struggling with is the cost of cars in the secondary market, used being more than brand new cars off the lot. Mm-hmm. Is that a function of inflation? It is a function of inflation. A lot of it, of course, is shortages. As you know, you could not for a long time buy a new car. I've heard so many stories from clients that I know that would tell me if you went to Dearborn a year ago, that half the side lots in Dearborn had F-150s, Ford pickup trucks that were sitting there that they had produced, but they couldn't sell because of the computer chip shortage. They were effectively not smart trucks, but dumb trucks. I know General Motors has done the same thing. Yeah, in fact, I noticed I was on 94 Sunday or Saturday, and in Ypsilanti, the old Ford plant, which has not been a Ford plant for many years, but the automakers are using that parking lot. It's abandoned, plant, but it's full. It's full of brand new cars. Yeah, it is. And when you go to talk about used cars, the challenge is when you can't get the new ones. Of course, people are buying used ones. Anecdotally, you'll run into other stories about even if they can buy them. I have a car that's been in the shop for 4 weeks. I can't get it fixed because the dealership is down technicians because they can't hire enough people to build them. So it's just, it's across the board. The good news is that there are some economists that think that inflation to a certain extent may have peaked in March. Used car sales are starting, not the sales, but the actual prices are starting to trend downward a little bit. And we have certainly seen a little bit of a downward trend in oil. But we're not done with it. It's going to continue for some time until people spend their money. We do have a lot of pent-up savings. I was reading an article this morning that J.B. Diamond, the head of J.P. Morgan, said there's $2 trillion still in savings accounts that people accrued during COVID, from transfer payments to those of us that maybe worked from home remotely but got paid and couldn't spend it. It's going to take time to work that off. Yeah, I know people that want to buy furniture or they want to buy a car and they're just waiting until the supply is there or the prices come down, or both. Right. And there is one other thing that I think will impact the transition as well,
is when we got locked up at home with COVID, all we could do was spend on goods, right? There wasn't much in the way of services. And, I think back to my wife and I, who I do not recall doing much in the way of ordering an Amazon Prime and having deliveries. But boy, the last 2 years, all of a sudden, the Amazon Prime driver seems to have a direct route to my house, and I know him by name. And that will change as well. We are seeing, if you look at the data, TSA numbers going through airports, Open Table, which runs dinner reservations, even the data related to hotels and hospitality has all went up dramatically, because as we've started to reopen, people are willing and wanting to travel again.
So the trajectory is what goes up must come down?
What goes up must come down eventually, although inflation is very insidious. It sticks around, and the challenge is some of the biggest components to inflation are what we call sticky components. That is, for example, housing and rent, right? Once rent prices go up, and there's been a shortage of houses in the United States, when rent goes up, it's hard for it to come back down quickly. Some things like used cars can come down rather quickly. It can be helped just by increased production of new cars. So, and food and energy is going to take time to work its way out too.
And housing, you just can't overnight manufacture enough housing to meet the demand.
Correct.
So it's a much longer time for that.
Yeah, I saw something, again, I wish I could quote exactly, but the Fed is targeting, to try and get inflation back down to about 2.5% within about 2 years. It's likely that it's going to trend down slightly this year, and then maybe a little better in 2023. But again, there's also a bit of a misstep. One of the things the Federal Reserve does to try and bring, tame inflation, so to speak, is one, of course, they're raising interest rates. So they raised short-term rates 0.25% in March. The target is supposedly another 0.5% in May. And if you look at the futures of where people are projecting them to go, they're talking about having short-term rates at 2.5% by year end. If they raise rates too quickly or too high, they run the risk of slowing down the economy and actually causing a recession.
So how does that work? If it costs more to borrow, how is it just, does that slow down? It slows down borrowing and then slows down?
Yeah, effectively, the Fed has a dual mandate, they call it. So again, the Federal Reserve is the U.S. central bank. The dual mandate, one is full employment, which unemployment right now is 3.6%, historically low levels. The other is to control inflation. So in a recessionary environment, they tend to lower interest rates because they want to stimulate the economy. They want you to start a new business. They want me to buy a house, buy a car, etc. When the opposite happens, they raise interest rates. They try to slow down that rate of borrowing, to slow down the economic activity. And it's always kind of a between period where too high of rates could slow it down too much. And again, when they lowered the rates, they stimulated the heck out of the economy post-COVID. And we're somewhat paying the piper for that right now.
And I guess credit card debt is pretty high right now.
It is, but it's been manageable. In most cases, like I said, there's a lot of money still in the economy. So the borrowing cycle has still been pretty high. And certainly, probably the bigger impact, if the Fed doing it, is going to be slowing down the housing market, which obviously is steaming. If you've talked to any friend who sold their house and the multiple bids they got on their house and over asking price offers, it's been crazy. And we've seen where the 30-year fixed mortgage is rounding up to 5%. That will certainly slow that part down.
So the flip side to increase interest rates in borrowing is there should be an increase in yield for those that are either saving or buying those investment instruments. There
has been a saver's penalty, I would call it, post-2008. The federal government, of course, lowered interest rates after the great financial recession, and we never really raised them to a typical level that we had seen in prior decades. And it really resulted in the retiree that wanted to buy a 5-year CD that could get a decent rate of return, looking at it going, why would I want to do that? And, so across the board, anybody that's got a bank account that says, well, my savings account's been paying 0.2%, that's ridiculous. Short-term rates going up will impact those shorter-term savings accounts, money markets, CDs, those types of things. And so it'll allow you to invest more conservatively. I mean, one of the things the Fed policy did was force people with their money out of those safe investments into stock markets, into real estate, because you couldn't make money otherwise.
Yeah, in 2008, 2009, that was very painful for a lot of people because
Yeah.
a lot of people lost their whole retirement.
Yeah, they did.
All right, so 2008, 2009, what are the factors? I mean, did we learn anything from that period? Are we safe from a repeat?
I think we're in much better shape. If you look at the factors that occurred in 2008, 2009, one of them, of course, was debt, right? Businesses and individuals were in debt in an astronomical amount, right? People did not have savings. Today, Americans still have a lot of money saved. The savings rate over the last 2 years was huge. And again, I'll reference Jamie Dimon's quote about $2 trillion in banks all over the United States. Companies have levered up more because it's been easy to do so the last few years, but they still don't have the same rate of debt that they had pre-2008. So on the one side of it, you've got a lot less debt. And I would say I think people have gotten smarter. I think if you recall pre-07, everybody thought their home was a piggy bank, so it was constant refinancing and equity mortgages and whatnot, and that mentality's changed a lot. But the other major difference today is the state of the U.S. economy is strong. I mean, unemployment is 3.6%. You've got 11.3 million jobs available. One of the hidden things people don't see is wage growth is currently trending at 5%. It's very hard for the economy to trend downward when everybody's working and making money. The downside, obviously, is you're making 5% and inflation is 8.5%. But it is a growing economy. Now, internationally, it's going to be different. Europe, certainly, because of their dependency on Russian oil, is going to be problematic. Like I said, you've got a lot of issues over there relating to also to the war and the immigration influx. Everybody's leaving Ukraine, going into the Baltic states. And right now, China's shutting down. So, I mean, there's more global concerns. The U.S. economy's strong.
All right, yesterday, income tax filing deadline. So for a firm like yours, today's like, it's a holiday, isn't it?
I thought so. I was actually surprised. It was a pretty robust turnout in the office today, so I figured people had a lot of follow-up stuff to do. I think sometimes at a tax firm, a lot of people want to wait a few days, decompress, and maybe next week everybody will be on vacation. But it certainly is a long run-up, and it's interesting because if you think back to what's happened the last few years, in 2020 the federal government ended up extending tax season, I believe, to July 15th. Last year they moved it back a month, so we've had 2 long years of extended tax seasons, and this year it was more normal, and everybody had to get used to compressing into that short time frame and getting done. But we did it. We always do.
And now that we've hopefully all put the finishing touches on our 2021 returns, is it too early to start planning next year's?
Absolutely not. Now is a great time to take stock. There's a number of things that we look at. A lot of times I recommend clients take a look at their 1040 and look at the things for their tax return that may have been either pain points or out of whack for them. For example, if you had a significant amount of capital gains last year, maybe it's a good time to take a look at your allocation and see, can you make adjustments maybe from mutual funds to individual securities, or is there something you can do to have more control over those distributions? Another one we see a great deal, especially if somebody's retired and they're over 72 and taking minimum distributions from their IRAs, it's a great time to consolidate for a lot of reasons. You may have a 401k or a couple of company retirement plans, an IRA, and you're trying to take money out of 3 or 4 different locations because when the year you turn 72, the government mandates you do that. But many times it's easier to just consolidate them into one account and have one distribution. And then you can also avoid overlapping and a concentration. If you've got 4 different accounts and you're not watching them, you can end up with problems. And if all 4 of them are 25% in Apple stock, you might not even realize how big a concentration you have. So those are issues. And then the last thing we also talk to people about is look at your itemized deductions versus standard. Many times, a lot of taxpayers do not plan out their actual itemized deductions or their charitable contributions and their taxes. And there's a strategy called bunching that we recommend a lot. So if you have a $25,000 standard deduction and you're not hitting it, but you give away 10 grand to charity in a given year, for example, maybe you could give away $30,000 in 1 year and front load it into a charitable fund called a donor advised fund. And then that year you go up high enough where you can take an actual itemized deduction, and you give that money away over the next 3 years. You get the tax deduction today, and then the next subsequent 2 or 3 years you just take your standard deduction. And so you start bunching all these big expenses up at one time to get the highest maximum itemized deduction, and then take the standard the rest of the time. So it's good financial planning stuff that, one of my good friends that retired from Rehmann years ago used to always tell me that, tax planning is prudent, tax avoidance is illegal. And I just think that as a financial planner, we can help people with tax planning.
Well, the laws are written so we can avoid taxes. I mean, there are legitimate reasons that people can avoid taxes. Do people take full advantage of all of their potential deductions and various ways that they can lower their tax bill?
Unfortunately, no, and that's where a good tax advisor, a good financial planner comes in, because that's what our skill set is. I mean, as a certified financial planner, I know all this stuff, and I'm constantly, as part of a financial plan, reviewing somebody's tax return to say, hey, have you thought about this, or have you done that? We try to get the clients ahead of time. If a client knows they're going to sell a building, or they're going to sell their business, or they're going to do something, it's a lot easier to plan out what you're going to do ahead of time to either defer or save on some of those taxes than it is to walk in after the fact and say, hey, I just sold this building, I think I'm going to owe a bunch of taxes on it, what do I do now? And that is a challenge, because people don't always think ahead.
Some things you can't just unwind.
Correct.
Obviously, a lot to think about, and every day's different. So we appreciate up to the date information from you today.
Well, thank you. It's great to see you, Bart.
Good to see you too, Doug. Thanks so much.
Yeah.
Doug Barber, specialist in wealth management, principal at Rehmann. Lots more coming up on today's show. We'll check in